Welcome back to the Pro Ticker Podcast, your Thursday morning edition covering major financial magazine headlines, everyone.
Good morning. We really have a deeply complex map of headlines to navigate for you today.
Yeah, we absolutely do. If you are prepping for your morning meetings and, trying to figure out how a data center in Bahrain connects to Silicon Valley's ethics boards and how that all ties back to the Dutch semiconductor supply chain, you are in the right place.
It is a lot to synthesize.
It is. We are drawing today's insights straight from the latest CNBC reporting alongside a really highly detailed Reuters dispatch from March 5, 2026.
Right. Both pieces are just essential reading this morning.
Exactly. Our mission for this deep dive is to unpack the interconnected shockwaves currently hitting the global economy. We are looking at the U.S.-Iran conflict spilling into corporate cloud infrastructure, a high-stakes standoff between the Pentagon and the tech industry, and China's historic economic pivot. Okay, let's unpack this, starting with the Middle East, where the boundaries of the battlefield are blurring in ways we really haven't seen before.
Yeah, it's a fundamental expansion of how we define a conflict zone. Historically, we think of geopolitical tension in terms of borders, maritime choke points, or airspace.
Physical lines on a map.
Exactly. But what we are witnessing today is kinetic warfare bleeding directly into the cyber and corporate realms. The separation between national security operations and private enterprise infrastructure is effectively gone.
Which brings us to a rather chilling detail from CNBC's latest reporting. In the midst of this escalating conflict, Iran targeted Amazon's Bahrain data center. We are talking about AWS infrastructure here.
Right, which is huge.
That is the fundamental plumbing of the global corporate economy, suddenly just caught in the crosshairs of a sovereign military dispute.
George Kurtz, the CEO of CrowdStrike, really crystallized the severity of this on CNBC. He warned that while the public's attention is entirely captivated by the physical fighting, the parallel threat is digital.
Yeah, the invisible front line.
Precisely. When geopolitical tensions rise, cyber threat activity scales proportionately. Iran, aiming at a commercial data center, is a very loud signal that cyber warfare is moving past mere corporate espionage into the realm of, structural, systemic disruption.
I have to play devil's advocate here, though. Are we looking at actual structural disruption, or is this just standard nation-state hacking that we've lived with for a decade, just rebranded because there are missiles flying at the same time?
It's a fair question, but it is the scale and the target that changes the calculus. Taking down a single company's internal server, that's espionage. Attempting to disrupt a regional AWS hub is an attempt to blind logistics, freeze financial transactions, and cripple the operational capacity of any multinational operating in that hemisphere.
It's an economic weapon.
It is a massive economic weapon.
And looking at the political reality of how this conflict is being managed domestically, just impartially reporting the facts on the ground in Washington, a war powers vote recently failed in the Senate.
Right, we saw that late yesterday.
Yeah, and that legislative outcome allows President Trump to continue the current military strikes in Iran without the constraint of that specific congressional authorization.
And that legislative reality feeds directly into the primary debate currently consuming the markets, which is the question of duration.
Because the markets hate uncertainty.
Exactly. The economic fallout of any conflict is almost entirely dictated by how long it lasts. The official stance from the U.S. government is that this will not be a forever war.
Right.
You have prominent voices in the financial sector, like Charles Myers from Signum, predicting that operations will wind down within a matter of days.
But surely the consensus isn't unified on a timeline that optimistic. Days.
Oh, far from it. Many defense and geopolitical experts frankly beg to differ. They are actively advising their institutional clients to prepare for a much more drawn-out attritional engagement.
And complicating that timeline is the fact that the international alliances involved here are incredibly muddy. You would expect clear lines in the sand, but instead we're seeing significant stress tests on all sides.
The diplomatic posture is highly fractured. On the Western Front, the bar for any NATO Article 5 mutual defense action remains incredibly high, and it simply hasn't been met.
Furthermore, we are seeing key allies actively distancing themselves. Spain, for example, publicly rejected the White House's claims that Madrid had agreed to cooperate with U.S. forces in this conflict.
Right. That is a stark public divergence in strategy. You don't usually see that level of pushback in real time.
But Iran isn't exactly rallying a unified coalition either. The reporting indicates they are finding the very hard limits of their own strategic partnerships. Neither Russia nor China is offering any material support.
Which leaves the global economy operating in this strange, volatile gray area. You have a localized conflict with global cyber implications, but without a broader coalition war.
That gray area might explain the market's counterintuitive reaction. You would assume an escalating conflict in the Middle East equals immediate market panic, specifically regarding crude oil supplies.
You would.
But Jim Cramer brought up a fascinating analysis on CNBC, pointing out that oil is actually flashing a bullish signal for equities right now.
Kramer's logic there is rooted in how the physical commodities markets operate. There is an old trading adage that the oil market always seems to know everything.
Which is usually terrifying.
Right. But unlike equities, which trade on sentiment and future multiples, oil is traded by people handling physical logistics. We're talking shipping manifests, pipeline flows, refinery capacities.
So if the oil market isn't panicking, the equity market feels safe.
Precisely. The oil market is currently signaling that this conflict will not spiral into a massive, prolonged disruption of crude supplies. If oil isn't pricing in a logistical doomsday scenario in the Middle East, it provides a floor of confidence for the broader market. It gives stocks the room to run despite the noise on the front pages.
That tension between national security and private enterprise isn't just happening abroad, though. Let's pivot to domestic tech, because there is an unprecedented standoff unfolding between the Pentagon and Silicon Valley.
This is one of the most consequential stories of the year.
We are looking at Anthropic, the AI heavyweight. They have hit a staggering $19 billion annual revenue rate. And back in July, they secured a $200 million contract with the Department of Defense.
Which normally would be the ultimate validation for a tech firm. You get a lucrative federal contract, and the government gets cutting-edge artificial intelligence.
A win-win.
Right. But the intersection of Silicon Valley's internal culture and the Pentagon's operational realities is where this deal completely fractured.
Because Anthropic requested very specific assurances that their technology would not be used for autonomous weapons or mass domestic surveillance of American citizens. The Pentagon flatly objected, demanding the platform be available for all lawful use cases.
They want full operational flexibility.
But wait, I have to stop you there. Isn't it incredibly naive for an AI company to take $200 million from the Defense Department and think they can dictate the rules of engagement to the U.S. military? How did they think this was going to play out?
It is the ultimate culture clash. Tech companies are beholden to their engineers, their ethics boards, and their venture capitalists, who often view these red lines as non-negotiable for brand safety and talent retention.
True.
The Pentagon, however, views any restriction on a procured capability as a vulnerability. And when Anthropic held their ground, the Pentagon retaliated in a way that has sent absolute shockwaves through the industry. They designated Anthropic as a supply chain risk, or SCR.
Explain the gravity of that specific label, because to a layperson, a supply chain risk sounds like a delayed shipment of microchips.
In the realm of government procurement, the SCR label is a nuclear option. It is a formal quarantine. Anthropic released a statement noting they were deeply saddened, pointing out that this designation is historically reserved exclusively for U.S. adversaries and foreign espionage operations.
Wow.
Slapping that label on a homegrown American tech giant over an ethical disagreement is unprecedented.
And the broader tech industry is clearly viewing this as an existential threat. A major tech industry group, which importantly includes Google, has taken this straight to the top, expressing intense concern directly to Defense Secretary Pete Hegseth.
What's fascinating here is the reaction from direct competitors. Look at OpenAI's CEO, Sam Altman.
Right.
OpenAI actually reached their own agreement with the Defense Department, navigating whatever those requirements were to secure their contract. You would assume a competitor might quietly enjoy seeing a rival sidelined by the government.
Just take the market share.
Exactly. Instead, Altman took a very public stand, stating that enforcing the SCR designation on Anthropic is very bad for our industry and our country.
Because if the DoD successfully weaponizes this label against domestic companies over ethics, we aren't just looking at a procurement dispute. We're looking at a potential bifurcation of Silicon Valley. Companies will have to decide from day one if they are a defense-first contractor or a civilian-first tech firm.
It completely alters venture capital strategies. It forces a choice. Abandon your internal ethical frameworks and risk a revolt from your engineers. Or hold your ground and risk being blacklisted by your own government as a security threat.
That dynamic of governments forcing the hand of their domestic tech sectors is a perfect bridge to what is happening in Asia. China is currently undergoing a massive historic strategic recalibration, and they are watching this exact dynamic between technology and national security
Closely.
Let's look at two macro data points. China has set its GDP growth target at 4.5% to 5%. That is the lowest target they have set in decades. Simultaneously, they are boosting defense spending by 7%, which is notably their slowest pace of defense growth since 2021.
Those numbers paint a clear picture of a managed, highly calculated slowdown. China is accepting lower top-line economic growth as a permanent reality. They're attempting to transition their economy away from the hypergrowth of the past 20 years, which was heavily fueled by speculative real estate and local government debt, and pivoting aggressively toward high-tech self-reliance.
Shifting the foundation.
Yes. The slight deceleration in defense spending growth suggests this is a sustainable marathon-paced strategy rather than a panicked short-term buildup.
And the centerpiece of that marathon strategy is semiconductors. The Reuters dispatch from March 5th details how top Chinese semiconductor bosses are urgently calling on Beijing to pool vast national resources. Their stated goal is to create China's ASML between 2026 and 2030 to achieve total technological self-reliance.
To truly grasp the audacity of that 4-year timeline, you have to understand the staggering scale of what the actual ASML does. ASML is a Dutch firm, and they are the world's sole supplier of extreme ultraviolet, or EUV, lithography machines.
Break that down for us. What does an EUV machine actually do?
To understand EUV lithography, imagine trying to draw a highly detailed, perfectly accurate map of New York City on a single grain of sand using only a laser. That is the level of microscopic precision required to print the most advanced microchips on the planet. A single EUV machine requires 100,000 separate, highly specialized components, and those components are sourced from 5,000 different suppliers globally. ASML doesn't just build a machine, they manage a global ecosystem of the world's most advanced physics and engineering.
And the Chinese executives in this Reuters report are proposing that China replicates that entire 5,000 supplier global ecosystem domestically by 2030. It's like deciding to build a functional Ferrari from scratch in your garage, mining the iron ore yourself. But the report explicitly outlines 3 massive bottlenecks they face.
The choke points are severe. First is electronic design automation, or EDA software. Think of EDA software as the digital blueprints and physics simulators that architects need before they even pour the concrete. If you don't have the software to simulate the chip's design, you are just guessing. That software market is completely dominated by Western firms. Second, they lack domestic access to ultra-pure silicon wafers. And third, they need the highly specialized electronic gases required for the chemical etching processes.
You can have unlimited funding and the smartest engineers in the world, but if you lack the software blueprints, the raw silicon canvas, or the chemical gases, the entire assembly line freezes. So what is their proposed solution to the government?
If we connect this to the bigger picture, the Chinese semiconductor bosses are making a profound argument about how innovation is funded. They are telling relevant government departments that they must uniformly allocate funds so that the companies integrating these technologies can jump out of the barrier of fame and fortune.
Fame and fortune. That is a highly philosophical phrase to drop into a technical briefing about silicon wafers.
It really is, and it reveals the core problem with their current system. They are arguing that short-term, profit-driven research-chasing commercial fortune and academic prestige-chasing fame will never produce an EUV machine.
It takes too long.
Exactly. Building this technology requires a decade of grueling, highly coordinated, unglamorous foundational research that might not yield a single dollar of profit for years. They are telling Beijing to remove commercial market pressures entirely and treat this as a unified, state-directed survival project.
A total mobilization of human capital. It is fascinating to watch. Let's bring the focus back to today's trading session and what is actively moving your portfolios right now. Because alongside the geopolitics and the semiconductor wars, we have some heavy macroeconomic shifts hitting the take today. The global 15% tariffs are officially kicking in this week. Also, that prolonged Middle East conflict we discussed at the top of the show is already starting to noticeably dent India's massive remittance flows.
Those are two significant macroeconomic headwinds converging. Tariffs act as an immediate friction-heavy tax on global supply chains. As for the remittances, just to connect the dots on how that works, when a conflict drags on in the Gulf, expatriate workers send less money back to their home countries.
Which hurts the home economy.
A lot. That drop in remittance flows essentially drains liquidity from emerging markets like India overnight. It acts as a stealth tax on their local consumer economies.
In a standard market environment, the combination of new global tariffs and draining emerging market liquidity would drag the broader indices down significantly. But we are seeing incredible resilience today, and it is being entirely anchored by the tech sector acting as a lifeline.
The market is treating advanced computing as immune to traditional macro shocks. We are seeing notable market-supporting gains specifically from Micron, AMD, Broadcom, and NVIDIA. Whether the U.S. military is procuring AI from Anthropic or China is mobilizing state funds to build chip machines, the underlying demand for the hardware that powers it all is viewed by investors as absolute.
So as you navigate your Thursday, here is your roadmap for what to watch on CNBC TV today, straight from the producer notes. Starting at 7 a.m. Eastern, Becky Quick has an exclusive interview with Berkshire Hathaway CEO Greg Abel on Squawk Box.
That is required viewing. Berkshire's operations touch every corner of logistics, energy, and consumer goods. Abel's perspective on how these new 15% tariffs will actually impact supply chains in real time will be critical for setting market expectations.
Moving to 8:30 a.m. Eastern, we get the initial jobless claims drop. The Dow Jones consensus is calling for 215,000 claims. And then at 10 a.m. Eastern, David Ellison, the CEO of Paramount Skydance, is appearing on Squawk on the Street. This is his very first interview since finally winning that grueling, drawn-out fight for Warner Bros. Discovery.
The Street is going to be analyzing his every word. Since Netflix formally abandoned its rival bid, Paramount Skydance stock has surged 18.6%. But you have to zoom out. The stock still remains down 42% from its September high.
Why is the Street still so skeptical if he won the asset?
Because winning the asset means inheriting the balance sheet. Ellison has to convince the market that this acquisition was a calculated strategic victory for streaming consolidation, not just a wildly expensive legacy media ego play. He has a massive debt restructuring narrative to sell today.
And finally, keeping an eye on Capitol Hill today, there is a major headline likely to dominate the political news cycles. Goldman Sachs' top lawyer, Catherine Romler, alongside Bill Gates and Leon Black, are all set to testify to a House panel today regarding the Epstein files. That will certainly generate significant noise outside of the pure market fundamentals.
Synthesizing everything we've looked at today, the overarching narrative is a massive collision of systems. We are watching traditional kinetic warfare, aggressive national tech strategies, and the ethical boundaries of domestic mega corporations crashing into one another. You simply cannot analyze a U.S. defense contract without understanding Silicon Valley venture capital ethics, and you cannot look at Chinese GDP targets without understanding the physics of a Dutch semiconductor supply chain.
It changes the entire board. And that brings us to a final thought for you to mull over today as you look at your own investments. Consider how the very definition of a supply chain risk has fundamentally mutated right before our eyes. 10 years ago, a supply chain risk meant a cargo ship was delayed by a storm or a factory went offline due to a labor strike. It was purely logistical. Today, a supply chain risk is the ethical boundary programmed into an artificial intelligence model by a 20-something engineer in California. A supply chain risk is the inability to source one of the 100,000 microcomponents required to build a single lithography machine scattered across 5,000 global suppliers. The definition has moved from the logistical to the profoundly philosophical and geopolitical. How will this entirely mutated definition of risk reshape where you place your trust and your capital in the coming years? Thank you so much for exploring these incredible shifts with us. We'll see you all tomorrow morning with new headlines from major financial magazines.